Hello everyone and welcome to Alternative Design's July product launch. I'm Tim Harding, Chief Marketing Officer for Alternative Design, and as always, thank you for taking the time to join us today. As always, I will be taking questions at the end of the webinar, so if you have questions, please feel free to go ahead and type them in at any time into the chat box on your control panel, and I will respond to those questions when we reach the end of this particular webinar. So here we are, right in the middle of summer. Things are starting to heat up. We're offering nothing new this month, but we didn't need to because we've got four, I think, really superior products. Those who have, of you who've been with us for a while, I think have really seen a trend upwards in the quality and performance of the products that the banks are offering. And I think we've got as good a selection now as we've ever had. We're only featuring four this month. I mean, there are others available, but we just felt like these were the four most popular, the ones that you were putting most of your clients in. And so we thought we would simplify a little bit and go with four this month instead of six. They're going to be familiar to you. If you were here last month, you're going to see pretty much the same thing. We've got the Bank of the West Commodities Linked product, the Either Or product. We've got the Barclays 7-year Equity Linked product linked to a basket of 10 stocks. The Goldman Sachs Momentum Builder, which is my favorite product right now. And the JP Morgan 7-year High Yield Bond Linked product. So gives you a good cross-section into several asset classes, lots of opportunities to meet clients and prospects' needs, and I think you're really, really well equipped for the month of July with these. They've all improved slightly over the offerings in June, so I think that's good news as well. So let's just take a quick look and run through these. I'm not going to spend a great deal of time today on the details, since these are products that we have all featured before. We'll start with the Bank of the West Commodity Linked product. It is a 7-year product called the Income Advantage. It pays an annual interest payment of a minimum 1% or a maximum of 7.25%. And of course, it's linked to a basket of 5 individual commodities. These are the same 5 commodities that we saw in June: cocoa, coffee, corn, lead, and natural gas. In fact, if my recollection is accurate, these are the 5 that have been featured for the last several months. So they seem to have a high deal of confidence at the BNP trading desk that these are the commodities to be linked to. The way this product works, of course, is very simple. It's one of the easiest to explain. I call it an either-or product. You're going to get either the 7.25% interest paid annually, or you're going to get 1% paid on an annual basis. And the way it works is this. If all 5 of those commodities are equal to or greater than their initial price on the trade date, in other words, on the anniversary date, if none of them are negative, the client is automatically going to be credited the 7.25%. If one or more of those commodities is negative, lower than its initial share price on the trade date, then the client's going to be credited with the 1%. So they're going to get nothing in between. There's no averaging. It's either or. They'll either get the 7.25 or the 1%, depending on the performance of those 5 commodities. As long as those 5 commodities are equal to or greater than their initial price, then the client's going to get that 7.25 return paid on an annual basis. And so, you can do the math with this, but all you have to do is hit that higher figure once or twice in the course of this 7-year product, and you've got a really high-performing CD that's FDIC insured, principal protected, and guaranteed. So this has long been one of our more popular offerings, and so we're featuring it again here in July. Very simple to explain, easy to convey to a client or a prospect, and the potential for very handsome returns is certainly there. On the equity-linked side, we've got some familiar faces. We've got Barclays again. We have a more traditional market-linked CD from Barclays. A 7-year product, has a minimum guaranteed annual interest payment of 1.40% and a 5% auto cap with a minus 10% return floor. And the way that works is linked to these 10 individual stocks. Again, some familiar companies in here: Apple, American Express, ConocoPhillips, Ford Motor Company. Don't believe I've seen them in here before. PPL Corp, AbbVie, Bristol Myers Squibb, Cisco, Microsoft, and Williams Companies are the 10 stocks chosen for this particular offering. This product is not an either-or product. It utilizes the AutoCap calculation methodology, which, if you haven't heard it before, sounds a little bit complicated at first, but I got to tell you, if you can get your arms around the calculation methodologies for those FIAs, this is really pretty simple and straightforward. So the way this return is calculated is on the calculation date, which we in the insurance industry would typically call the anniversary date. We compare the price of each individual stock with the initial share price on the day the offering closed. So we just look at the change from one year to the next. It's rather like you purchased a portfolio of 10 individual stocks all on the same day. You know what the price was you paid for each of those individual stocks. And on the anniversary date, if you wanted to know how your portfolio was doing, you would compare the current price with the initial price of each individual stock, and that would tell you whether you were winning or losing in the stock market battle. And if you wanted to know what your average portfolio's return was, you would simply divide it by the number of stocks in your portfolio, and that would be your average return. This calculation works very similar to that, with one interesting twist. So on the calculation date, we compare the price with the initial price for each individual stock. If the share price difference is negative, and in other words, if one or more of the stocks has gone down, we're going to count that as a negative return, but not any lower than the floor. In other words, this product has a minus 10% floor, so even if we have a stock that goes down 30%, we're not going to count a negative 30. We're just never going to count more than the minus 10%. That's what the floor is. It's like a safety net or a stop loss. So if the share price is negative from the initial share price, then we're going to count the negative down to a minus 10. If the share price is positive, in other words, if the stock is equal to or greater than its initial price, we're automatically going to credit the 5% cap to that stock for purposes of determining the average. So the client's either going to get the negative down to a minus 10 floor for an individual stock, or the cap of 5%. Then we're going to add those 10 returns up, both positive and negative, divide by the number of stocks in the basket, which in this case is 10, and that's going to be the interest payment for that year, unless that calculation is lower than the minimum guaranteed amount of 1.40%. So the client will receive on an annual basis the larger of the 1.40% or the average of the 10 stocks, whichever is larger. Then we have two more product offerings this month. Both of them are linked to indices. And I've talked before about how progressive the bank indices are. They're dynamic, not passive. They're really cutting edge, and so these are two of my favorite products because I'm a big fan of indexing, but the problem with indexing is, as you know, is that it's a passive investment style. These particular indices have a dynamic aspect to them that makes them, I think, a lot more attractive than the standard, S&P 500 linked products. So the first one we'll talk about is from J.P. Morgan Chase. It's a 7-year product, has a minimum guaranteed annual interest of 1%, and it's linked to the J.P. Morgan High Yield ETF Volatility Index. And there's no cap. So here you have an uncapped CD, depending on the performance of the J.P. Morgan High Yield ETF Volatility Index. That index mirrors the holdings in the PIMCO 0 to 5 year High Yield Corporate Bond Index ETF. And so you've got one of the world's best and largest bond management companies in PIMCO managing this particular exchange-traded fund. The nice thing, or the dynamic aspect of this particular product, is that it has a 3% volatility control on it, which means that as long as the volatility in this index is less than 3%, the index will have a 100% exposure to the PIMCO ETF. So 3% is the maximum volatility. Once the PIMCO product exceeds a 3% volatility, the JP Morgan index reduces its exposure to that index to reduce the volatility. In other words, to smooth out the returns that the client of JP Morgan is going to be receiving on the CD. It's a very nice dynamic function in the product. You can see here the historical performance is steady and straight, not any big swings, and that's because of the volatility control that is placed on the JP Morgan index. So very, very attractive product for those clients and prospects who want to see a little bit higher return than they can get in the the safer corporate bond and investment grade bond marketplace. This can give them exposure to those high yield corporate bonds, otherwise known as junk bonds, without having their principal at risk. And the returns on this particular product have been very attractive indeed. A way to get a little bit higher return without taking more risk. Now, of course, here's my favorite, and I've actually dedicated an entire webinar to this product, so I'll try not to get carried away with it. But the Goldman Sachs Momentum Builder is one of the nicest looking products I have seen in a long, long time. It's a 7-year product, uses a calculation methodology that I call annualized point-to-point, and I'll walk you through that because it makes sense once you've heard it a couple of times. But it is a multi-asset linked product, meaning it's not tied to just stocks or bonds or commodities. 100% participation rate on this index with no cap. Once again, a CD with virtually unlimited upside. It's referred to as the Momentum Builder. And it pays an annual minimum guaranteed interest rate of 1%. So the client's going to get whichever is larger, that 1% guaranteed return or the annualized point-to-point return from the index. Now, the big news about this product is that it is a true multi-asset product, and that has tremendous power, as I've talked about in 2 or 3 other webinars. I'm going to show you once again. This is what's called a rules-based index. It means it's governed by math. There is no money manager deciding what to go into and get out of. It's all done by proven mathematical strategies using momentum-based investing and modern portfolio theory. And this is a dynamic index. It's rebalanced each and every month. So it's not passive. It's not stagnant. You don't have constant exposure to the same asset classes. You get exposure to asset classes distributed across 7 different classes depending upon the math. And the performance has been, as I've said before, quite exceptional, and I'm going to show you that in just a minute. But this is a true multi-asset linked product. You can see there's money market as one component there. Developed market stocks, U.S. bonds, emerging markets, and alternatives, including real estate and corporate debt, commodities, and inflation-linked U.S. treasuries. So you've got a good cross-section here of 7 different asset classes governed by a mathematical formula that can be back-tested and shown. Well, you can see historical performance if the index had existed for any length of time. You can see here on this chart since July of 2004, that red line right up the center is the performance of this particular CD. And you can see it over time because of the volatility in the other asset classes. This one is, again, nice and steady and solid growth. I mean, it gets outperformed by some asset classes at some times, but it certainly doesn't take the losses that all of those asset classes do under certain economic conditions. So you've got really an all-weather market-linked CD here. I would put this up against any mutual fund or ETF out there. This is real diversification. This is a product that you can bring to even your more aggressive clients in terms of investing. Here's why I think it's so powerful. we all know that diversification accounts for 90% of the total return of a portfolio. You can take a look at this and you can see that these returns are not spectacular. In fact, overall it's averaged about 6.5% on an annualized basis. But the place I always like to look is at 2007, 2008, 2009. How did this fund do then when the market, from its peak to its bottom here in the United States, lost over 50%? You can see there's only one negative in this entire back test, and that was in 2008, and it was only minus 1.54. Look at 2007, 2009, it was up 5.34 and 7.51%. And remember, this is at a time when the stock market is going through the cellar. So this is the power of diversification. This is one of my favorite products. You can give someone an entire portfolio here wrapped in the safety of FDIC insurance with a guaranteed return of principal. Absolutely a marvelous product. I would put that up against any mutual fund or ETF, as I said. The calculation methodology is a little bit different than some of you may have seen before. I call it an annualized point-to-point. Basically what we're going to do is on an annual basis, we're going to go from the initial index price to the anniversary date price on the index, and then we're going to divide that by the number of years that the CD has been in existence, and then that's going to be paid annually. So you can see in this example from the disclosure documents, on the first coupon determination date, which would be the first anniversary, this hypothetical says the return was 4%. And it's the first payment. It's the first anniversary. So we're going to divide that 4% by 1 for 1 year. 4% divided by 1 is 4%. So the client's interest payment in that first year would be 4%. You can see in the second year, the gain from the initial index price to the end of the second year anniversary is 8%. But since it's the end of the second year, we're going to divide that 8% by 2. Once again, that's 4%. Client receives 4% that year. Go down to the 7th coupon determination date. Down at the bottom, we see in this hypothetical that the index has a cumulative minus 8% return. So we're going to divide minus 8% by 7 because we're in the 7th year now. That comes to a negative 1.14%. But because this product has a guaranteed minimum annual interest payment of 1%, client would receive 1% in interest payment in that year. So what you've got here is a product that's really going to allow you to diversify your clients, build them an instant portfolio, touching on stocks, bonds, commodities, even real estate and corporate debt. So if you haven't taken a good look at the Goldman Sachs product, please do. I think once you get your arms around it, you'll see that this is a very, very powerful tool to have in your toolbox. We've got a reasonable selling period or offering period for the month of July. All of the products have the same cutoff date, July 24th. So you've got a good three solid weeks and then a little bit more to get out and write the business. So we're looking forward to a very, very good July. For product offering keeps things simple, but I think they're very, very powerful products. So with that, quick run through on the products. I'll be happy to take questions at this point. If you haven't already typed your questions into the chat box on your control panel, please feel free to do so, and I will respond to as many of these as I can. Let's see, Lisa asks, does the interest have to be withdrawn at the end of each year, or can they remain in the account and compound? Lisa, the interest has to be paid out. It cannot compound in the CD. Once the offering is closed, at the end of the month, no more money can go into that CD. So if the interest payment were to be reinvested back into the CD, you would now be putting money into a 7-year CD, or a 6-year CD with a 7-year term because 1 year is already gone. So the banks don't allow that to happen. So in order to compound the interest, you would have to take that interest and place it somewhere else. You can always, of course, purchase additional new CD offerings in $1,000 increments once the account is opened with that interest, and that's what a large number of people do. They take the interest payment and buy additional new CDs. Jerry asks, if a client wants to withdraw all of their money prior to maturity, do they get any interest earned sitting in the cash balance of the CD? Yeah, once interest is earned, Jerry, it is retained. So hypothetically, a client could be in a product 3 years. 3 interest payments may have been made. That interest is sitting in a money market account, in their custodial account. It's not going anywhere. If the client wants to cancel the CD, that interest is retained. Bart asks, is there a 6-year market-linked CD this month? The answer, Bart, is yes, I believe so. However, I think that we left it out because the compensation was less than attractive. But if you have a specific instance where there's a need for 6 years, or for that matter, any unique circumstances, please don't hesitate to give your business consultant a call. We'll be happy to see if what you need for a particular client is available and secure it for you. JB wants to know, how did it do in 2000, 2001, 2002? Don't know, JB. I haven't seen back testing that far back. I'll see if I can dig it up. That would be interesting. I see the point you're getting at. Same point I was trying to make in 2007, 8, and 9. We had similar circumstances in 2001 and 2. And so, yeah, I'd be interested in seeing those, JB. I'll see if they're available. Interesting question. Jay says minimum dollar amount for each of the CDs. Minimum amount to open an account is $25,000. The CDs themselves are actually sold in $1,000 increments, but in order to open the account, there's a minimum requirement of $25,000. But since the CDs can be purchased in $1,000 increments, that doesn't mean $25,000 has to all go into one CD. Instead, it could be split up in $1,000 increments. You might have $12,000 in the Goldman Sachs and $13,000 in the Barclays. So it's just the total account value has to be $25,000 to open the account. Fern asks, where are the CDs custodied? Our CDs are held by Provident Trust in Nevada. They serve as the custodian for the CDs, and it is in a self-directed custodial trust account. Rick asks, do you have access to a commodity CD other than the all or nothing one? And I believe, Rick, the answer to that is yes. I've seen a couple. I don't know off the top of my head with a certainty, but we have available to us, a couple of hundred CDs. So in all likelihood, there is a commodity CD that's available that is not all or nothing. Once again, if you have a specific need with a client, let your business consultant know, and we'll track it down for you. Question on the compensation on these CDs, really pretty straightforward. The Bank of the West commodity-linked CD, the Income Advantage, what I call the either-or product, pays 2.5%. The others all pay 2% this month. So pretty easy to keep straight. The commodities product at 2.5%, the other three 2%. Jay has a question. Is interest payable to the beneficiary if death occurs during a particular year? Yeah, the interest payment on death is really kind of interesting. Jay, basically the beneficiaries are driving the bus at that point. Once a notice of a death with a death certificate is turned in, the client has 6 months basically from the time of death to decide whether they want to retire the CD and receive 100% of their principal back. They have that option. Or hold on to it until the next interest payment. As long as that interest payment is within the next 6 months, the bank will go ahead and pay that interest, and then the beneficiaries can surrender the contract, or the beneficiaries can also hold the CD till maturity as well. Fred asks if the minimum is now $45,000. If I misspoke, I apologize. No, Fred, it's $25,000 is the minimum account amount. I may have stumbled over my tongue, but no, it's $25,000, not $45,000. Jerry asks a question: can you put qualified money and non-qualified money in here? And if qualified money, what happens with RMDs? That's a really good question, Jerry. Both qualified and non-qualified money is acceptable. RMDs are handled in a unique way, which I will be happy to have your business consultant explain to you and walk you through. It's really kind of a unique way, and it's painless and very, very effective. Question: do you ever buy these types of CDs in the secondary market? Our only new issue? No, we only offer new issue. The primary reason for that is if there is a secondary market for the CDs, then they are likely going to be classified as securities. The new issues are not securities. They're FDIC insured bank deposits, and so we do not deal in the secondary market. I do know that there is a secondary market for this type of CD, but we do not participate in any way. Rick asks, have you back tested the bond CD? Yeah, there is some historicals on that, Rick. I'll see if I can put that together and get it out to you. Question again from JB: how has the commodities product performed on prior offerings? How often do these commodities typically all go up? Approximately what percentage of the time typically? Good question, JB. Commodities have performed very poorly in the past, actually past 18 to 24 months. Commodities have been down substantially, so on this product, the return would have been the minimum 1%. We're beginning to see some positive movement up. I would say now would be a good time to jump on board with commodities. Commodities, as you know, are cyclical. They have reasonably wide volatility swings, but in all candor, the last 18 months to 2 years, commodities have performed very poorly, but as you know, past performance is not indicative of future performance. So we still offer the product because we still think there's a place for this asset class in a portfolio. Okay, good questions today. We'll be sure and have your business consultants follow up with you. I appreciate you taking the time. More questions than I expected, but that's a very good thing. Thanks once again for joining us. Have a wonderful 4th of July weekend. We'll be back here same time, same place next week, 11:35 Pacific time on Wednesday. See you then.